The most successful traders throughout history all share a mastery of one concept, and this concept led George Soros to break the Bank of England, and even Michael Burry to predict the housing market crash, which I shouldn't have to tell you are some of the biggest P&L trades of all time. And that one concept that great traders share a mastery of is rotations, or an understanding of where and why money moves in the market. Now, while you may never collapse an entire bank by yourself, this is a concept that we as traders can exploit from a day-to-day basis to not only maximize our gains, but better position ourselves for the future. And by doing so, we put ourselves in the right position to win and score big. But majority of retail traders have lost the understanding of this concept, which is why in today's video, I'm going to bring to the light many of the core components that make rotation such an effective concept. By the end of this video, I hope to pass on a professional perspective and understanding of rotations that was passed down to me by my professional mentors. Now we have a lot to cover, from breaking down what is this concept to begin with, to case studies of trades that I've taken in my own account that were based around this concept and how you can replicate it. So all I ask of you is your attention, and let's get started. So why are rotations important to you? Before we get into all that, we first have to define what is a rotation. What are rotations? Simply put, rotations are just describing the flow of money, where money is pulled out of one thing and it's put into another. That seems pretty elementary, and it is, but that's as far as most retail traders get. But believe me, it gets a lot deeper. So now that you understand the basic definition of a rotation, let me explain to you how it mechanically works through this simple visualization. Trust me, if you watch this, you'll know how we're going to exploit it later on. But so once upon a time, a while back, there was a bunch of people who said, you know what, I want to put all of our money into one idea, and then we all get a piece of what happens, right? That is the idea of an investment. And so one day, a bunch of people, you, me, mom and pops, your dog, we all formed our money together and we gave it to someone who knew what they were doing, or that we formed it ourselves. And that created the banks, investment funds, the hedge funds, all these different guys. And so these banks and institutions, their job was to put their money into the market. They held an obligation all along, right? That when we put this money into the market, we are doing it in your best interest to make you money, and we're just going to skim a little bit off the top for doing so. That was the idea behind it. In today's world, sadly, a lot of retail traders lost sight of that. They think these banks are malicious institutions that just take profits out of the market, put it into cash, and then go buy their Lambos. No, they keep their money into the market. These people over here did not give the bank their money to cook them dinner or to buy a car. They gave them their money, this investment fund, to invest. So they want to put their money into the market. They don't want it out. So let's just assume theoretically no one ever takes money out of the market, at least for more than, let's say, 2 hours. With that idea, it's kind of like, okay, well, wait a second. Then what happens when that money grows? Or what happens when the conditions of that market changes? Well, then you're going to have these people over here that the bank is acting in their best interest, wanting change within their investment. And so that creates a rotation. And it creates a rotation because not only does the bank want their clients to do the best they can because that makes them more money, but also, of course, because the changing interests of the people who funded the bank, who they have an obligation to, is changing as well. They're like, hey, this market's going down. I want something else than what I currently have. And that's going to force the market to do what? It's going to force these guys to sell one thing and buy another with that same pot of money, because they can't just all stay in the same thing as these conditions are changing. They're not going to. It's against human nature. It's against the mechanics of the market. And so within a market that they were investing in, there's now really three main categories that everything falls under. Whether you trade crypto, whether you trade futures, whether you trade commodities, it falls under one of these three. Is it a growth asset? Is it a value asset? Or is it a defensive? And the reason these are important, these groupings, is because this is what drives rotations, because these different assets have different kind of risk curves to them, different attractions to them during different market conditions. And that's going to cause these guys to start barking in these guys' ears, and these guys are wanting to obviously do the best for them. And so they're going to move their money between these different things. And it's going to give us an opportunity that we can exploit if we understand the laws and rules behind it. So if you're going through this right now, the three categories are defensive. These are things like non-cyclical, anytime, any place. These are your names like bonds. These are your names like Walmart. Things that just are always going to be there, that always provide sort of a stable business model. And of course, Walmart, they're always going to be selling toilet paper. No one's just going to give up on that. So that's going to be there a while. And you can see their risk curve is not that high. You're not going to make an exorbitant amount of money with Walmart on a single day. It's not going to go up 50% in one day. That's highly unlikely. But during certain markets, like we said, this might look attractive. When a market's going straight down, maybe this does look attractive, right? Maybe these defensive names are attractive, and that's going to cause, again, a different flow of money. Now, the next one, value kind of blue chip things. These are industrials, production names, guys that are really involved in producing things in typically great balance sheets. These have slightly higher risk curves, and that's something that you can say, hey, maybe in a different market condition, that's also attractive. And of course, growth as well. Risky, Tesla, things like that. These guys are ultra growth, and these have their own markets or their own times where they start to shine. And again, we can exploit this not just on a macro basis, but on a very micro day trading basis as well, spotting the different relationships between these and how we can take advantage of that. Now, the most recent evolution to this process, and one that actually has given us the greater opportunity to exploit this process, is that investment firms moved online. Markets are now online. And with that technology being incredibly fast, getting faster every single year, the markets move towards automation. They move towards complexity. And with that complexity, the big investment funds acting in their best interest, it's no longer these guys just barking in their ear what they want. It's algorithms deciding for the bank, for the people, what is best. And it's not its own machine, but it's programmed by these guys to do certain things with those assets. And so what you've actually had nowadays is, of course, the algorithms running the markets. And how do they do that? A lot of them are pinned to some arbitrary risk metric, like let's say 1.2, it changes down to 1.1. That's going to cause an action from the algorithm to rotate money into one of these different categories. And which stocks of tickers, blah, 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 it all varies between different funds. But because they're all pinned to an algorithm, it's almost like the machines are all reacting in the markets. It's no longer humans that are really making all of these decisions. And so what you get is market conditions that are heavily driven by rotations and by this concept, and which makes it incredibly easy to take advantage of and actually profit from. So in this time, now you have these computers that sometimes even they're doing these rotations hundreds of times a second, or other times big funds often, of course, they're a lot slower and they take their time and it's more obvious when they're doing it. And so that's where the bigger opportunities are over the course of many days. You will have an algo that will maybe look at Tesla. It will, go into Tesla and it will have to sell something to afford that. So they're going to sell, of course, their bonds. When you sell one thing, you have to buy another. And again, when you sell one thing, that's an opportunity. And when you buy another, that's also an opportunity. So there's always, in every single market, as Jim Cramer says, there's always a bull market somewhere. And there's also always a bear market somewhere. And that's because of rotations and how we can always exploit these different ideas, so long as we know the rules and relationships that these assets have, but also, again, the rules and the laws around how firms actually rotate, which again, I'm going to show you all in this video today. So rotations are a mechanical component of the market. So long as the markets are around, rotations will be as well, giving us a reliable strategy that we can rely on. As far as I'm aware, banks, institutions, and investment vehicles will always be around. And so long as there's clients who's interested in investing, markets are still going to rotate. Because when the clients give these funds their money, they want it in the market. And so when the markets see one asset to be more attractive than the other, that means they're going to sell one thing and put that money into another. But now comes the question of how do we go about and actually exploit this process? It seems like a general concept, but we can do so by being more narrow and specific by analyzing the sectors and industries and knowing the relationships between them. To best take advantage of this concept of rotations, we have to be able to look at the markets through an efficient lens. It is no surprise that the markets are huge. There's so many different pockets, so many different assets types. How do we scan through majority of them to find where the opportunities or rotations or money flow is going into? Well, on screen now are going to be the list of tickers that you will just use for the rest of time. These are going to be the sectors and industries of the US markets. These two lists are going to allow us to scan through basically basically the entire market to see where money is flowing into and out of when we use our tools. Going forward, this is going to be your bread and butter to knowing what's going on in the market and where the next opportunity resides. Sectors are more broad than industries. Industries are more niche. However, all of them fall under one of the three categories that we mentioned earlier, being a growth, value, or defensive kind of grouping. On screen now, I've color-coded which ones they are. Of course, growth being green, value being gold, and red being defensive. There were two names that were blue. These are called wildcards, and these can act as both depending on which rotation they're getting. Again, which is important for when we look at the tools. Whether they're growth, value, or defensive, it gives it a unique characteristic depending on which one it is and how it falls into the rotations and what we should play. Certain times of the market call for us to play defensive names, and certain other times call us to play growth names. And to be ultra clear, the reason I say these two lists are really all you need is because each one of these tickers I displayed is a sector or industry, and they all have their own individual holdings within those ETFs. And the lists I put on screen encompass majority of liquidity in the market. While there are smaller pockets of the market, more niche sectors and industries, we really focus on these ones because this is where majority of market participants are and liquidity is, making it so every name that we trade has a good chance to be tradable with decent option spreads, but as well as equity, right? That your spread between your bid and ask is also good and that it actually can move. So now that you have all the sectors and industries hopefully written down, you can now apply them to several different tools to analyze the rotations and flow of money in the market. The first tool we're going to actually look at to help us exploit this idea and concept of rotations is the relative rotation graphs, or RRG charts. This is available on a variety of different platforms, from Optima, Bloomberg Terminal, to just Stock Charts, which is the cheapest and where it was actually founded. What this tool actually visualizes for you is the rotation and flow of money between different sectors. Now, how do we actually read this tool? What are the different components of it? From a structural standpoint, this tool is made up of a few different components. First of all, you'll notice the obvious, the different quadrants. There's improving, there's leading, there's weakening, and there's lagging. The improving and leading is relative to SPY. It is comparing the individual sectors or industries, if you do put one on here like KRE, to whatever you have as the benchmark. And that's important because when we compare individual pockets to an overall rating, we can see whether it's outperforming, whether it's underperforming, and therefore we have an idea of the rotation that's going into it. What's important about this tool is it measures momentum. You'll see two different measurements, the momentum metric and the RS ratio. These together just can help us identify where the rotations are going. Remember that rotations are automated, they're from algorithms and computers, and they also take time to complete. And so by using this tool, we can get an early sign of when there is a rotation in a particular grouping of stocks, giving us an early warning. And by that reading or warning, we can see when it is likely to outperform from that quadrant into the other. Now, this is a leading indicator, and it is a leading tool that can help us identify where the markets are going to go next. It is a future-looking idea. And how do we draw effective conclusions from that? It's going to come from this little cheat sheet right here. This summarizes everything you really need to know about the RRG chart tool. So first of all, of course, there's the time frames and things like that we'll get into, the best ones here, but also different selections we can do from crypto, everything else. But what I like to focus on is, again, the sectors and industries. And particularly with the tool, I like to focus on a few different things. First of all, the distance from the center is important. The further you are from the center, the more momentum you can expect and the stronger that this rotation is likely to actually be. You can see over here, when you see just a little squiggly close to the center, that means that it's operating really close to the benchmark in performance and there's not a notable rotation going into it. Again, to exploit this idea of rotations, we want to find where there's money swinging into and where it's being pulled out of. And that's always going to be shown by the further it is from the center. Additionally, we want to see a clear trajectory. We do not want to see squigglies that go up and down in all which direction. We want to see a clear and strong path that it is taking. Preferably, you want to see it going diagonally across the different zones. And we'll talk about which zones are best to look at when identifying certain directions. But for example, right here, you can see this is a squiggly down and it's going all which direction. That is not something you want to look at. However, this right here, strong direction going diagonally, this is something to look at. And if you can kind of visualize this, what you want to kind of visualize is a top spinning. You want to picture a top spinning. You want to ideally see these rotations going in, ideally a perfect circle like this, to show that there is some sort of strength and correlation between them, that they're actually getting a rotation. So when you see things like this that are going, outside of this kind of expected move here of this rotation, it's something that we will not consider. Other than that, what you can expect, of course, is these zones. Where are the proper zones that we're actually looking at to take action and get an early warning that there is a rotation going on, that there is money flowing into something or out of something else? That's going to come down to these two zones. Ideally, in a perfect world, the best long trades, the best ideas to see where there's money flowing into is right over here, from lagging up into improving. And for the best short trades, over here, from weakening and heading into lagging right here. These ideally are the best spots to take either short positions or long positions. Now, I say that with a little bit of caution because we don't just follow this tool blindly. We have to be very intelligent about how we read this tool. The first approach I like to take with this tool is analyzing the different sectors. While we can go and look at a variety of different individual tickers and everything else, what I like to start on is using these sectors to gauge whether there is a growth rotation or a defensive in value rotation happening. Now, what does that mean? Well, like we said earlier, there are kind of rules to how banks and institutions and hedge fund will rotate their money in the markets. When they're rotating it into growth, it is likely a sign that there's going to be continued optimism in the market and that there's going to be more upside. When they're taking it out of defensive, that is further sign of that. When they're moving money into defensive, however, and selling growth, they have to sell growth, that is a sign that a market drop is to come. And again, this is a leading indicator. We get ideas before they actually happen. So how do we actually see a growth rotation and a defensive rotation, which can be leading signs of either a pump in the market or a drop? Well, we're wanting to look at a buddy system. We want to look at how they're grouping up on this chart. So by applying, again, all the same rules that we talked about over here, that they're over here, and that they have clean, they're far from the center, they have clear trajectory, they're not squiggling. What we want to look for is growth sectors grouping up and defensive and value sectors grouping up on one side. And going back to the color-coded sectors and industries I showed you, you want to consider that these are the groupings you want to see. You want to see stocks like XLP, XLRE, XLU, or not stocks, but ETFs, as all grouping up. You want to see the defensives all grouping up. Now, these two names are the blue names that I mentioned. These are growth defensive names, and they're wild cards. And they behave like whichever one they're grouping up with. So sometimes you'll see XLE or XLV group up with growth, or, and then that means it's a growth name, it's moving with them, so that would behave like a growth ticker. However, most of the time they move with defensives, and so you want to do that. So you want to see them grouping up with defensives, and you also want to ideally, to confirm a rotation is actually true, see, growth sectors grouping up, XLY, XLK, XLC. You want to see them having similar trajectories, similar paths in the similar zone to confirm that rotation. Now, what does that actually look like? Well, this right here on screen is what's called a growth rotation. And what you have is, on one side, coming up into the lagging and improving, you see money is flowing into the growth stocks. You notice that there's XLY and XLK. These are moving in unison. No, they are somewhat far apart, but they're moving in unison. Look how they're heading in kind of the same trajectory. This fact that they're in the same quadrant kind of zone here, over on the left side, and they're swinging over from lagging into improving, that means money is rotating into them. Now, what about defensives and value? Well, defensives and value are all over here. Notice XLB, all these other guys, they're grouped up. They all have similar trajectories, and they're going down from weakening into lagging or leading down into weakening. This is called a growth rotation because what you have is money flowing into growth and they're starting to sell off defensives. That is an early sign that markets are likely to move higher. Now, it is relative to the time frame that you select, just like price charts are and the idea that you have, but the 60-minute, typically the framework is that within around 4 to 6 hours, you will typically see a move higher based off of this reading on the 60-minute. So what happens here is you'll notice that right after this continues higher and the markets do begin to rally, and they rally around 10 points here all the way up here. However, on the flip side of the coin, whenever you have what's called a defensive rotation, which this is one, and additionally this is one, where you have a rotation out of growth right here. So notice what happens here. When you have a rotation out of growth and into defensives, they swap places, that means that the markets are likely to drop soon. So check this out. You have XLE, you have XLU, all these defensive and value names over here. Money is flowing into these guys. And therefore, to buy defensives, what do they have to do? They have to sell something else because, again, money cannot just leave the markets. Clients want their money in the markets. So when the firm buys one thing, the algorithm is going to go reallocate. They're not going to take the money out. They're going to reallocate. That's a key word. They're going to reallocate those funds into something else. And when they reallocate, it's going to be more into defensive stocks if the market's dropping or about to drop or hitting certain risk metrics. So whenever we see this, this is a sign that we have less risk on buyers, that we're less supportive of the market, and it's likely to drop soon. It's a leading indicator. All the same cheat sheet metrics still apply. We're still looking for all the defensive names to have this kind of clean trajectory and everything else. But notice how they're having that buddy system. They're all grouping up. They're all in unison. They all have similar trajectories, and they're all similarly away from the center of the screen. This is what you want to see to confirm that a defensive rotation is actually happening. Now, there is one exception that the growth rotations, will sometimes see that XLK is by itself. This is because it is the biggest and largest one. When you think of XLK, you think of NVIDIA, Microsoft, Apple, right? All these different huge mega cap names. And so really this is the only one that needs to be to confirm a growth rotation. So if all we have on this side is XLK and all the other guys like XLC and XLY are all doing their own thing, that's okay. And you'll notice even XLY is doing its own thing over here. We just want XLK. It doesn't matter about XLC and XLY. Preferably, we get XLY and XLC to group up with it, or maybe even energy or something like that, but we don't need it because technology is so large in the market. So right here, you'll notice again, we have a swinging out of XLK coming into that zone. It doesn't need to perfectly be in that little red zone we talked about, but it needs to be swinging from leading into weakening. That confirms that there is going to be a defensive rotation soon, so long as defensives are on the other side, defensives and value. And so what this kind of indicates is there's going to be a drop soon. And you can see as soon as that started to happen, between around 4 to 8 hours, 4 to 6 hours, that this rotation actually was complete, and we saw a drop in the market. Now, there are a few things you need to remember when you're utilizing this approach with sectors on the RRG charts to spot rotations. First of all, the momentum of the current trend dictates what you're actually going to see as an outcome of this rotation. For example, if we have a market that's going straight up, just a nuke to the upside, when you see a defensive rotation print on the RRG chart, it is not to infer that the markets are going to just plummet. You can infer, though, that the markets will slow down in the pace of their buying. So when you have a huge, large momentum trend to the upside and the markets are ripping, you only want to conclude that it's likely to chop and slow down, aka you can expect some sort of consolidation, so maybe you start to trim your longs, etc. It is not a good idea to go and sell your growth during that, sell the trades that you find, and then go and buy defensive names during that time. That's not necessarily what you want to do, because in the case of when a market is ripping super high, it's going to be growth outperforming, and when you're going and trying to get out of growth and get into defensives, it's not the most optimal thing to do. Additionally, when you have a trend that's, let's say, going straight down, when you see a growth rotation, that is not a sign that you're likely to see a instant rocket bounce. What you want to infer, though, from that, if it's a high momentum trend to the downside, you want to think that it's just going to consolidate. Again, just maybe form some sort of counter parallel, a flag, and then ultimately continue to the downside upon finishing that rotation. So the momentum does dictate the signal and what you can actually anticipate when you do see a growth or defensive rotation. Now, what are the best time frames to trade? I know all you guys are going to look at this and say, Raider, what is the best time frame? I need to know. I'm fiending to know. Well, I'll actually tell you. So the best time frame actually to look at, in my opinion, is going to be the hourly. However, with that being said, there are kind of different time frames. It's relative to the time frame that you look at. So I'm a swing trader. I do options. Typically, my day trades or things like that are not really that short. They're a few hours at the smallest, and so I'm not really scalping things. And so I typically look at the hour, so the 60-minute. However, on screen now, I'm going to put on a little cheat sheet. This will actually show you how long it takes for each quadrant to be reached. So typically, just one quadrant for the 1 hour takes about 7 hours, 4 to 8 hours, somewhere around there to actually move through it. And so if we take that principle, we can actually, infer that, well, okay, if it's coming into, we start to see these things start to swing up towards improving, then we can infer that this rotation will start to take effect within the next 7 hours. So maybe 1.5 days, right? And that's where we're going to be looking long. So that's what you want to anticipate from that rotation, is say, hey, this effect is likely to happen over the next 8 hours. And then the follow through is unknown. The follow through could happen for weeks on end, right? Because once that rotation completes, it will take a while for that next rotation to show up, and who knows how strong that trend's going to be once that rotation finishes. So that's what I typically look at. The other time frames are shown, but I will say, of course, the longer time frames are the better ones. So stick to around the 1 hour for that market sentiment or information rather, or the 30-minute. I wouldn't go as far as the 5 or 10-minute. They can give very mixed signals and often be very noisy. And secondly, I use this tool mainly for information. I'm not actually going and I'm placing trades based off of this. However, let's say that we have a move higher we think is going to happen. We see a growth rotation print on the RG charts, like right here. What is our play to go long? How would we go approach this? Well, the best way is probably not to go short defensive names, because if we expect a long trade in the market, it's likely that defensive names will still creep higher, but they're going to be lagging the market. Remember, lagging doesn't mean down. A market could be going straight up, but lagging does not mean down. And we have to really think about that. So what I typically do is, let's say we see a growth rotation happening. I would want to now go find which growth stocks are likely to move higher. And so what I can do is I can go to XLK or XLY, and I can look individually within those sectors, what are their holdings. And so you can go and you can click XLK, and it will show you the individual holdings. Now, notice how the benchmark changed from SPY to XLK. That's perfect, because what we want to analyze is within that sector that is improving, what is the improving and leading stocks within that. So you want to apply the same principles. You want to find things with clean trajectories. You want to find things that are preferably in improving, or maybe even over here leading, which is an exception for individual sectors. But that's what you want to do. So we already vetted that it's improving relative to SPY. So we go in individually to this sector or industry, and you find what are those individual holdings that are also performing within that to find that idea. So maybe PLTR, maybe MU, crowd. I'm not necessarily going to look at something like W day for this bounce, because this is lagging. I'm not going to necessarily look at something like CDW, because these are lagging. These are close to the center. They're not likely to move as aggressively. This is a general rule of thumb. It's not a law to follow, as sometimes these do go absolutely ballistic. However, this is the better way to kind of capture and screen stocks. You're screening out the BS, and you're finding the gems very quickly. Again, efficiency. That's what we're aiming for with this tool. Now, I did want to add in one more piece of information, because I'm sure a lot of you guys are wondering, Raider, how did you come to the conclusion that this is the best zone? Why, statistically, is this the area where we want to be involved for a rotation? Well, there's a lot of great research out there, and I'm actually going to show you guys. If you've been a follower for mine a while, you probably haven't seen this, but there's a lot of great research out there to suggest this, and that I think one of the best research papers you can go read around this, specifically why we look over here instead of over here, is by Matthew Verdoff, I believe his name is. But he basically went and he found a bunch of signals, and he did a bunch of back testing, and he found that the different probabilities of closing into different quadrants, but not only that, he went and found the profitability. So basically, he took a net gain. He said, okay, when this condition is met, here's what we want to see, and here's how much profit it would make. And so across 20,000 or so signals, I mean, there's tons of studies on this, you can actually see the P&L profiles of when these different sectors or tickers swing into these different quadrants. And so what you'll notice is these lines in the middle right here are when it actually hits that sector. So right here is improving, and when it comes into this gray line, that means it's in the leading, and then vice versa. So we have lagging and then weakening. So all these right here. So when the line comes in and hits this, that means it's now an improving. So this side right here is improving, right? So it would finally hit improving. What you'll notice is, where is the biggest gain? Where is the biggest net increase? Well, you can see that from lagging, right? So from lagging, right here, here's lagging, you have an increase, into improving, you have an increase. So if you look at this gain, you go from, I think this is 2.8, or let's just call it 2. So you go from 2, or 2.5, whatever it is, I think it's 2. So you go from 2 all the way up to 0. So that's a move of plus 2. And then you go from 0 all the way up to about, let's just call it 1.5. So together, that is around 3.5 increase of total movement, right? And you can notice from leading, improving to leading, you'll notice that we go from 2 to around this, but here you can notice it's not as much. So you can see we don't even get over 1 here. So this is really where you want to be involved. And you can notice from leading to weakening, it's kind of bad. It goes from 2 and then it swings back down into 0. And then, so this is very bad. You don't want to get involved in anything here. So the biggest kind of P&L increase that we want to be involved in is from lagging to improving. This is where we see kind of that biggest opportunity. The cleanest gains is from lagging to improving. By the time you're already in leading, you don't see much gains. And so this is really where we want to be involved over here, not over here, especially when this, takes a lot back and then it kind of decides if it wants to bounce. This is where we want to be involved. And likewise, short, you can see that from weakening into lagging, you have a very steep drop. Of course, additionally, with this drop here, it works in your favor. But additionally, the other part of that research was looking at, hey, what are the probabilities that it goes and closes in each quadrant, right? If we're improving, what is the probability that one sector goes into leading? And you can see right here, that's it. So when we're in the improving sector, or the quadrant rather, in that sector moves from improving, it has a 68% chance to move into leading. That's a pretty good odds. And that's, of course, I believe on the daily time frame they tested this. But you can also see that moves weakening here, that or it's actually various time frames, but you see moves. So when you're from leading and it moves to weakening 92% of the time. Now you'll notice 92% of the time, does that mean we short? No. That means it slows down. Most trends, all trends slow down. And that's why it's 92% of the time when it starts to outperform the market, it often gets pulled back in towards that VWAP or back into, that moving average just to find liquidity once again, once it extends beyond that deviation. And then you'll notice the highest percentage again from weakening moves to lagging. We've known this, that once stocks start to weaken, they start to eventually underperform the market. And then also you'll see lagging to improving 90%. So again, with the 90% chance of going from lagging to improving and having the biggest profile increase, we can infer that the best place to actually long is here. Hence why when we look for a rotation to be confirmed, we're not only looking for the trajectory, the distance from the center, but we want it to be in these ideal zones because that increases the probability that this rotation is actually going to happen and follow through and give us a good signal to anticipate what the future price action will be. Hope this makes sense. Now, the best use cases for this tool will be outlined when we show examples later on in this video through our case studies. However, this RG chart tool is likely not to be effective in volatile markets. I have not found success with it as this tool does not take into account gaps. It will not take into account market gaps. So when you have these huge after-hour gaps, just because you see some sort of growth rotation doesn't mean that, if the market's gapped down 2%, that there's actually a growth rotation going on, at least one that's actually going to result in anything. So the best use for this is in non-volatile markets. Typically when VIX is under 25, that is when you can see great effect from the different signals and understanding where these rotations are actually going. So now you have one effective tool to spotting rotations, but what if I told you that this next tool is going to fix a major problem that many of you unknowingly have, and that is which names you're picking when the markets do reverse. See, a lot of you go out and you try to find different tickers or different crypto to trade when there is going to likely be a market bounce, but you're picking the wrong names. Instead of going for the broken slot machines or the names that will likely move most throughout the different phases of a market reversal, based off of the rotations, you're picking the names with mid to average gain potential. Great traders have extremely large winners, and by following this process that I'm about to show you, regarding leaders and laggers, you are going to be able to position into the market properly to maximize your gains and pay yourself more when you are correct, based off of just your understanding of this rotational concept. So there's a concept that not many traders have mastered in the market when it comes to understanding rotations in the market. See, when these big firms and entities, institutions go out and they reallocate, so they take their funds and they put it into something else, they're doing so based off the performance of certain assets. And whether they're a lagger, which is the name that is lagging behind the trend, or a leader, which is the name outperforming the trend, they are going to have different rotations. So in a market bottom, the names that are solely sold off the most, that are the most beaten down, these are referred to as laggers. And if we're looking for a market bottom, the names that sold off the least are referred to as leaders. And you, again, going back, leaders or laggers, what is that referring to? It means the names that outperform during a specific period of time and the names that underperform during a specific time. And if we look at these different names, what you'll actually notice is playing a market bottom. This is not what a lot of traders do. You actually want to play the bounce in the laggers first, because initially the rotation into the laggers is the strongest. It's the quickest. You're likely to see the most rapid gains. However, in the second phase of that kind of market bounce, you'll see they get sold off very quickly because they're often not the companies that have the actual attractions of the market. They're just the most beaten down, meaning they sold off initially the most because they're oversold and that there's likely a lot of shorts in it, and that's going to fuel a bigger rotation into it. In that second phase, you'll see them often get sold off aggressively. In that phase, when you start to see the laggers in a market bottom get sold off aggressively or start to underperform again, that is when you go and you look at the leaders. The names that did not sell off as much during that downtrend, that last downtrend, and that are holding better, those are going to get the longest continuation trade. So it goes from laggers to leaders. And if I can help you visualize this a little more, what a lot of you traders are doing is you're going out and you're finding some random ticker like Tesla or the name that's in the news, and you're longing that for a market reversal, not knowing that the gains off the initial low are very subpar. But when you put these two pieces together and catching the reversal of the lagger, but also rotating for the later part into the leader, you can see that the P&L of this is so much larger than any other piece you could put together. And that is the theory behind it, is that in the different phases of the market, the rotations are going to favor one asset or the other based off of its performance. Now, for a market top, the leaders and laggers concept still applies, except it's a little bit reversed. So initially, when you want to play market top, you'll notice that the laggers do not get the initial biggest sell-off. It's actually the leaders, the names that bought the most. Think recently the mega caps like Nvidia, all these other guys who have been really aggressive to sell off the highs. And then after that, the stage two, you'll see laggers, they have, somewhat of a little bounce, something here, but the leaders get bought up the most. So they get sold off the quickest, but they get bought up the most, similar to how the laggers get bought up the quickest, but they get sold off the most for that second phase. In the third phase, the names that always get beaten down more and last longer, the continuation trade, is the laggers, the names that did not get bought up as much as the leaders over here. The leaders will provide more consistent trades as well, but the laggers, the names that did not get bought up as much as the leaders prior to that top, is going to get more beaten down and see the bigger short trade. And in between market bottoms and tops, the continuation trades, in a downtrend, you want to continue to short the laggers. So let's say this is not the market bottom and you expect more lows here, you would want to continue to short the lagger as it continues to go lower, as that will see the worst performance. Additionally, in an uptrend, you want to continue to long the leaders, as that will have the biggest and longest trend to the upside with the more consistent gains. So whenever we spot a market reversal, if we can find the leaders and laggers, then we have a path to knowing how to maximize our gains and pay ourselves more for our correct decisions. By exploiting the rotations, we can pay ourselves more just by knowing what's a leader and what is a lagger. This is what so many traders fail to do. When they go correct, they only pay themselves a very small amount, and then when inevitably losses come back, they can't weather them and they can't survive because their winners are not drastically bigger than their losers. To find leaders and laggers in the market, we need a tool that can help us efficiently spot the leading and lagging sectors or industries. Well, the best tool to use is, of course, the one I built purposely and specifically for this concept on my platform. I'll never put a tool on my platform that I don't personally use to write the reports, to research, and to post my trade ideas. This tool right here will demonstrate the leaders and laggers very clearly for you. Right over here to the left, we already have as default the different sectors and the industries for easy access. You don't even have to type them in. You just simply click the box and it will show them independently. Up here at the top, we have a custom time frame that you can set along with default time frames. I like to use the custom time frame, and what I like to do is take it from the last major market dynamic change where there was a previous rotation up until the current point that I'm trying to find a trade, whether it be a bounce in the laggers for a market bottom or it be a short in the leaders for a market top. And one of the most textbook examples that I can show you for demonstration purposes, one of the bigger ones, is of course COVID. So what we're going to do is we're going to type in 2020 and we're going to go to March of 2020. And so I'm going to go back and I'm going to go to February. I think the drop of that happened around the 21st of February. Perfect. And so we're going to go from the 21st of February and we're going to go to March 23rd of 2020. And we're going to see what were the most beaten down names throughout this COVID destruction. Of course, we don't need a COVID-like event to take advantage of this concept, but what were the most beaten down names? And let's go to the industries here. Well, you can see by the most beaten down names, we have OIH, XOP, and jets. These all down over 58%. Airlines, some of them went down even 70% plus within this time frame. And if you go look at SPY, of course, SPY did not go down 58%. It did not go 80% down. It only went down around 35%. So this is a clear lagger. All these names at the bottom, these are your laggers. Up here, the names that are outperforming or not selling off as hard, these are your leaders. And so when you look at a market bounce, remember back to our criteria, a lagger is the name you want to play first for the initial rotation. That because they're so beaten down, they're going to get the sharper reaction once money starts flowing back into the markets. Firms are going to position into the laggers, the most beaten down names first, and then later on they're going to position into the leaders, the names that did outperform and that are more attractive, maybe fundamentally or something like that. So right here, initially for a market bounce, we would be looking at XOP, Jets, or OIH. And you can see, okay, cool. So on the 23rd, you would be looking, if you thought there was going to be a bottom, for Jets, XOP, and OIH. And what do you notice between that period? Well, if we measure the performance of the bounce after the 23rd, you'll notice that markets, specifically the airlines, from the 23rd up, they went up nearly 64%. From the low, they went up almost over 100%. Whereas if you go to SPY, from the low in that same time period, you can see SPY made a new low even. So it didn't even go up. It only went up from the 23rd to the 26th, only around 13%. So you took advantage of a 130% bounce in a name, while the overall markets only went up 13%, with also making a new low. So by playing the laggers, not only did we position ourselves better by playing defense, but we're also playing offense, that we made more. We didn't make a new low, but we made more in that correct name. Okay, so let's say we got that initial bounce in the laggers, and now the laggers are starting to sell off. So from the 27th to, let's just say, the April 7th, you want to start to what? Now you want to play the laggers. So we're going to go from the 27th and we're going to go to the 7th of April. So now that we're looking at this time frame, we can now see what were the leaders. And you can see most of everything is being picked up obviously now, but what were the leaders that we can start to play? Well, actually oil in, OIH, oil services and production, these guys start to become leaders. And that's interesting. Sometimes laggers do become leaders, but you can see jets is still down here. We don't necessarily want to play jets. So what are some of the leaders we can play? Well, we can look at solars, we can look at retail, maybe even the energy names we can give a shot, or biotech. So we're going to go in and we're going to look at these specific industries. You can also do the sectors, get a more broad-based view. Okay, materials, healthcare even, maybe technology, energy. And if you go look through that window of time from the 23rd to around the 7th and beyond, what were the outperformers? Well, just to take a quick benchmark of SPY, you can see that from that time frame, we really only went up around 10%. So if you look at energy during that same time frame, if we go back to 2020, you can see, well, from that time frame of the 2020 bottom, which would have been the March, April, May, you can see that energy from the 26th onward went up well over 66%. So the leaders got the continuation trade, not the initial bounce. The leaders got that good continuation trade. And if you looked at the other ones, such as solar, so if we look at TAN, this was another one that was heavily beaten down. You can see that during that time frame right here, so March, April, this went on to an absolute monster rally, right? That over time, these went up well over, after that COVID rotation into 2021, almost 400%. So this is how you're supposed to play the rotation. So from the bottom, initial bottom, the rotation is in the laggers, but the continuation trade is in the leaders. Now, while you don't need a massive multi-week time frame to take advantage of this can be done on very micro time frames that we can see, okay, well, if today we expect to bounce into tomorrow and Tuesday and Wednesday, let's play the laggers first. Let's play the continuation in the leaders within that time frame. And so this does benefit day traders and swing traders alike. And the best way that I can show you that it benefits those people is by showing you case studies or trades that I've published on the RADER Report that demonstrate these exact principles that are free of hindsight bias, because I post my ideas before the week starts. So this right here is the RADER Report, and this is the weekly edition that I release every single Sunday that outlines all the trades, the theses, the entries, the data, everything about how a trader can position to best take advantage of the week ahead. Specifically, this is an insight to how I am personally positioning in the week ahead. And what's really good about this is you can go and look at all the historical reports that I've posted, at least most of them, the last 20 or so weeks. And so this one was from March 2nd. And so this is a really good case study for how this rotational concept can be applied, from the RG charts to the leaders and laggers, and how to position and apply these concepts. So the week of March 2nd was right here. And the thesis behind this report was that we were nearing some sort of seasonal bottom, that we were expecting that, hey, into March 15th, it is possible that we see just a little bit more low, but a rally up into March 15th, some sort of strength. And that strength is going to last at least till March 15th. And that we were expecting some sort of wave 2, some sort of bounce in the markets. And all the data pointed towards that we would see some sort of bounce in the market given Friday's strong close. And if we didn't see a bounce, that we would see some sort of wave of strength in a few different names. And we saw this from the PC ratio, and we talked about, that there was kind of a big put in balance, and that we were likely to see some sort of move higher. And so the trades outlined in this report were focused on that, from the home builders to the trade of the week, which was actually Solars. Now, Solars here is a lagger. It was a beaten down name. And if I expected there to be a market bottom into March 2nd, then we expected, hey, the laggers are going to get that bigger bounce. The laggers are the first to bottom. They get the rotation first, and therefore they're going to get the biggest move higher initially, right? Not necessarily the longest move higher, but initially they're going to see some sort of move higher off of that bottom, since they are a lagger. So right here, this was a lagger that I found, and ENPH had been selling off aggressively. However, there was, of course, technical and, structural signs that this was nearing a bottom. We had a technical bottom last time, and then you had a massive volume spike, the biggest since August 5th, I think, of like 2023 or something, or October 2023. And this was a huge day for ENPH. It suggested that there was a liquidation and that the buyers would now be taking over very soon. And so the idea was, additionally, there was some flow and things like that, but this was an A+ setup for me. The idea was that this was a lagger, it was beaten down, and if the markets reversed, the Solars would get the biggest bounce off the low initially. That's how the laggers work off a market bottom. We're playing the rotations. We're exploiting this market mechanic that when the markets do reverse, the laggers get the quickest first initial bounce, and then you play the leaders if it does actually bottom. So by playing the laggers, I'm playing defense. That, hey, maybe it's not a complete market bottom, but we do have signs of a reversal. So if there is just a little bit of strength, I can outperform the markets. So when you look at what actually happened to the markets during this time period, we didn't actually get a market bottom. Like, we didn't get a huge reversal or anything like that. But from the second all the way into Thursday, we had this period of kind of strength, that the dips were being bought up quite aggressively. And that is all you need. And if you look through that same time period, right, from that third into the rest of the week, this was a massive mover. And one of my biggest trades of the last few weeks, ENPH. This moved off of the low well over 10% in a single day. And then the next day after that, it moved almost another 5-6% and even another 5-6% after that. So at the week's end, you moved from top to bottom almost 20%, over 20%, while the SPY didn't actually close green on the week. This is called defense. This is called when you see strength, when you have an idea, whether it comes into the overall market or not, you play the concepts. As I showed you earlier with that UAL and the SPY during the COVID, UAL continued to bounce while SPY made a new low. But because that was a period of strength, because we understood how the rotations actually work, that firms were rotating into the laggers regardless whether SPY or made a new low or not. So when you suspect a market bottom, when you expect a reversal in the market, you want to play the reversal in the laggers first and then play the continuation, if it is a bigger bottom, into the leaders. And this was not a multi-week time frame that I was looking at this. I determined this trade just from the last few days of price action, that if we do expect a bottom into the seasonal period, then for the next 2 or 3 days, we can expect into March 15th or the next 10 days that we would see some sort of strength in that. And you can see within my positioning here, I mentioned that the best signs to trade a bottom were the most beaten down growth names alongside software and semiconductors. Now, the next trade that also followed this principle was NVIDIA. NVIDIA was a beaten down name. It was sold off higher, or sold off more than the overall markets were. And you could take the same percentage point from the initial start of the drop, which was February 21st, all the way down. That's where I was studying these different leaders and laggers. And you can see from that period, this was down almost, 25%, while the overall market SPY were not down 25%. In fact, from the 21st, I don't even think they're down 10%. Yeah, so they're not even down 10% from that point. So obviously, NVIDIA being a beaten down name, if we expected a market bottom, well, coming into that next week, right, on this report right here, this was the report of March 9th. This was the next week. We also had another thesis. Okay, last week, the lagger, we didn't actually get a bottom, but the lagger still paid. And so when we go to a trade like NVIDIA and like AVGO, this had quite a big liquidity attraction up to 123. We're nearing potentially a liquidation level, and maybe I just mistimed last week's bottom. And so what happened was the overall markets, you can see right here, they started to form a better base, but it still was not the quote-unquote bottom that you can see right here into the 10th. We started to form that base based off max pain that started on the 11th right here. We started to form that base, and that's kind of that bottoming trade. And so when a market starts that bottoming process, what is the best trade to go and pick? The most beaten down initially, right? The most beaten down trade is going, or the most beaten down names, the laggers, are going to be the best bounce. And you can see from that day, from the 11th past, this rallied almost 20%. Now, the options didn't pay that much. I think through this entire move, I only made about 150%, but this was a classic example of how to manipulate and play rotations. We wanted to see a liquidation below 105.06. We got that by literally like 20 cents, and then it rocketed beyond that. That was max pain, hit the golden zone, entry calls up to 123 by 321. That's what we got. Now, of course, everything else from the options and the technical setup, that's a whole different process. But when it comes to paying yourself more, whether you're an equity trader, whether you trade crypto, commodities, whether you trade futures or even options, you need to know this concept, because if you're not playing the laggers here, then you're not going to maximize your bounce. You're not going to maximize your capital, your winners, when you are correct. And again, the best demonstration of this, if you go look at leaders such as J&J that actually did hold better, you can see that, well, yeah, J&J from the 11th, it was a leader. It didn't sell off as much as the overall market did. In fact, it's up. It is a leader. It's leading the market. It's not down. The markets are down. And so if you went and played this during that same time period, you'd actually be down, right? That from the 11th to this, if you're not playing the laggers, you're losing money. So it matters which names you're picking, because that's where the rotations are going to pivot in first. That's where institutions and firms are rotating and reallocating money first. And then later on in the trend, if there is an actual market bottom, and that's where the market sentiment actually resides now, that's when you go play the continuation in the leaders. That's when you go play J&J. That's when you now go play ENPH and all these other names that are now leaders. So here are two more examples of us applying these rotational concepts, both with the RG and the leaders and laggers concept of rotations to the markets. So this report, this was the week of December 15th. And so as we were nearing this important options expiration of December 20th, being the largest of, the indices for the year, over $6 trillion in, derivatives were expiring on December 20th. As we neared that, we noticed that there was a rotation out of growth names. So here's a rotation out of growth. They're swinging over here. And then you had a rotation into a lot of the defensive names. This was a sign that markets were going to likely drop soon. And if you looked into this 15th, this was what we were looking at. This is a sign that we were likely to drop. We have this consolidation at the high, weakening momentum. And the fact that you have this defensive rotation at the time was like, hey, we're likely to see some sort of drop here. And with that being said, there was a few different trades that we actually wanted to look at. Even though the markets were going to drop, that a lot of the beaten down names and things that were really far extended would likely be good dip buy trades. So that's how we kind of used that, and it worked pretty effectively. But overall, we were expecting that there was going to be some sort of bigger drop in the overall markets. And one of the names that we did end up playing was Microsoft. This was a leader of the previous trend, of course, being mega caps, and this was our downside trade. Now, additionally, one way that we also applied laggers again was that through my research the week of the 29th, this was right around here. And so we had already formed what appeared to be some sort of technical bottom. This was a liquidation after OpEx. And so I was thinking, you know what, if this is going to be some sort of bottom, or maybe it's not the liquidation, that we're in this bottoming process. And whether we're actually at the bottom or not, we've seen doesn't matter. If you're in the right names, it doesn't matter whether we've actually reached the actual bottom or not. So in this bottoming process, we went to go trade what? We went to go trade the laggers. And the laggers were names like energy. The laggers were names such as the squeeze names that were, kind of, it was the trade of the week. But the squeeze names were names that were smaller caps like MPW that were really high short floats and that were likely to get squeezed. And you can see it was heavily beaten down. And instantly of that week, December 15th, or the 29th rather, this was the week of the 29th, this instantly rocketed. So one of my biggest trades of the week was MPW, these squeeze names. And then also, during that same time frame, we had energy. Energy was another big name that was extremely beaten down that we had an idea in, and that was based off of this flow order here. XLE during this week of the 29th, you can see it was pretty beaten down, and we wanted to see a bigger bounce in this. So the beaten down name got the first initial bounce. You can see it didn't get the follow through into January as much as some of the other names did, but regardless, this is how you position for things, is you're in the laggers first, and then you position into the leaders once that initial bottom has actually, concluded. Hopefully today you learned the concept of rotations and how we as traders can exploit this mechanical process in the market. Legendary traders like George Soros and Michael Burry, while they aren't using the RG chart tool or necessarily the concept of leaders and laggers like I do, they understand that where money flows and where it's likely to be pulled out of is where trading opportunity lies. When Michael Burry thought that the housing market was going to crash, he didn't just go short anything. He didn't go short biotechs, he didn't go short internet stocks, he went and shorted the direct sort, the names that were likely to be toppled the most, the housing market. He knew that this leading sector was going to be the name that got rotated out of first and likely would be the one that got slaughtered the hardest. If Michael Burry would have shorted something else, who knows if this trade would have been as legendary as it is today. Thank you so much for watching today. Traders, if you feel like this video was informative, believe me, there's many of these concepts and more that I put on the RADER report, which is where I put in detail my trade plans for every single week and month. I was trained by professionals, and through my perspective with them, I was able to find and master the mechanics of the market that I publish on a weekly report. From the trades, entries, exits, the trade ideas, and even the live data tools and private lessons that I put on there, I put my heart and soul into it. There is a 14-day free trial, so you have nothing to lose to try it out for a few weeks, and if you want to stay with it, I would love to have you. I'll put the link in the description, or you can just go to theradarreport.com and sign up there. I'll see you guys in the next video. Have a great day. Bye-bye.